In today's episode, we will take a closer look at what is in store for ASEAN's fastest growing economies in the year ahead. And that is, of course, we are talking about Vietnam. Vietnam maintained its status as one of ASEAN's bright spots. Its improving economic fundamentals, competitive labor market, and wide-ranging free trade agreements have been instrumental in maintaining the country's allure to foreign investment amid the China Plus One strategy. Indeed, the economy grew stronger than expected in the second quarter of this year, reaching an impressive 6.9% year-on-year. This brings the first half growth to an average of 6.4%, supporting our full-year growth forecast of 6.0% for this year. This is a notable pickup from the 5% growth seen in the previous year. A closer look at the sectors contributing to the strong GDP growth shows that while the construction sector's growth was resilient, the outperformance in the manufacturing and services sector has been key in supporting the recent recovery. The strength of the sectors partly underscores improving electronics export growth. Electronics exports, which accounted for around 33% of 2023 exports, increased by 21.9% year-on-year in the first half of this year, compared to 2.2% contraction saw in 2023. Looking ahead, the bottoming out of the global electronics down cycle by the first half of this year, in line with our house view, will allow for a more sustainable recovery of Vietnam's electronics exports. In addition, resilient growth in key trading partners as US, China, and Japan bodes well for Vietnam's overall growth trajectory. Indeed, we forecast Vietnam's economy to grow by an average of 6.2% annually between 2025 to 2026, which also partly due to strong foreign direct investment prospects and improving trade outlook. Total registered foreign direct investment rose by an impressive 13% year-on-year in the first half of this year, reaching $15.2 billion. Encouragingly, the manufacturing sector remained as the key primary recipient of FDI, with a 26% year-on-year increase, reaching $10.7 billion. This reflects Vietnam's deepening integration into regional supply chains, as well as the positive outlook for electronics manufacturing growth. Future prospect remains bright. Vietnam is ranked among the top destinations considered attractive by foreign investors. A recent survey by the Japan External Trade Organization placed Vietnam at the top of the list for future business expansion destinations in the region, beating China, India, Indonesia, and Thailand. However, there are some downside risks to be aware of. Vietnam's growth heavily relies on exports, so any slowdown in global growth or increasing trade disruptions should be closely monitored. On the domestic front, addressing and preventing power shortages, which were experienced in 2023, remains a priority. To that end, the implementation of the National Power Development Master Plan 2021 to 2030 is expected to significantly increase energy supplies in the coming years, making energy generations more reliable. Moving on to inflation, while we anticipate higher inflation in the coming months, forecasted average CPI of 4.3% for the full year, it's important to note that this remains within the State Bank of Vietnam's target range of 4% to 4.5%. The risk is that extreme weather patterns could continue keep food prices elevated, posing an upside risk. So what does this mean for monetary policy ahead? Well, we think the SBV's focus will likely remain on mitigating currency depreciation against a backdrop of relatively steep inflation and improved growth. Our base case remains for a cumulative 50 basis points in rate cuts from the SBV's, likely in late second half of this year. However, the risk is that sustained depreciation pressure on the Vietnamese dong could limit the SBV's room to maneuver.